Hi everybody, this is AJ speaking. In this video I want to discuss the NIO investment case. Today is July 15th. At time of this presentation, NIO trades at $4.20. The company is down 4% year to date, but recently rallied 20% from $3.5 per share to the current $4.2 per share. This values the company right now at $9.3 billion. The following analysis is using management guidance, year to date, vehicle sales, various other company announcements, and my global automotive research to come up with a hopefully accurate estimate. On this first slide, you see the total revenue development. In 2024, Rivian delivered $9.1 billion in revenue. The forecast implies $10.9 billion revenue in 2025, and then significant growth in 2026 to $15.9 billion. The significant 2026 increase is based on the assumption that the recently launched Onvo brand and Firefly brands both see continuing strong adoption, since both are significantly lower price point vehicle brands. NIO's third brand is the NIO brand, but NIO sells at a higher price point. However, as you're going to see later in this video, the NIO premium brand is seeing stagnation or a downward trend. On the second slide, we look at the deliveries breakdown. The different colors signify the three different brands which NIO is selling through. You can see historically NIO went through some rough times. When you look down here in Q2 2024, for example, or Q3 2024, NIO only had NIO brand sales, and the NIO brand sales significantly decreased year on year. You can see here how the blue bars significantly reduced year on year. But we will dive later into NIO's vehicle portfolio in more detail. And by looking at the headline, you already see the key issue this year. NIO guided for a doubling of vehicle sales, which implies 440,000 vehicle sales in 2025. However, after the first 6 months, we have reported vehicle sales. NIO is only at 26% goal achievement so far. For this reason, the forecast does not assume NIO will actually get to 440,000 vehicles, and is currently calibrated for 375,000 vehicles. This, however, would still imply a 69% year-on-year growth rate, and the forecast also assumes very strong growth into 2026, with a 53% year-on-year growth rate to 2026 full-year vehicle sales of 575,000 vehicles. I think what's currently driving the stock is the strong year-on-year June sales number, which you see down here. In June, NIO delivered just under 25,000 vehicles, implying an 18% year-on-year growth rate for that month, and implying a 2Q growth rate of 26% year-on-year. And I think this was driving the recent share price rally. However, as I will demonstrate in a second, this is overlooking a key point. On this slide, we see the first part of the key issue. So what does this slide show? It shows trailing 12 months deliveries for all of NIO's models. The solid lines comprise models for which a full trailing 12 months period is available, and the dashed lines reflect vehicle models which started not long ago and for which we don't have a full 12 months period. And when you look closely, you can notice a couple of things. First of all, if we start with the NIO ES6, which is by volume the by far most important product within NIO's lineup, you can see that this vehicle has basically flatlined for basically a year at around 75,000 vehicles on a 12 months basis, and has in the last couple of months started to decline. And just to be very clear, the 12 months metric eliminates seasonality, with one exception, and the exception is when Lunar New Year falls in months in a way that Lunar New Year is twice in one trailing 12 months period, but this is not the case in this chart at these endpoints that are the most current. So when we go down these models, so the best-selling model sees a downward trend. The second best-selling model, the ET5 5T, is a few months ago peaked, but is now coming down a bit. Let's ignore for a second the dashed lines. These are the new models. The third best-selling vehicle, the EC6, is also flatlining and coming down slightly. And then the fourth best-selling vehicle, the ET5, is also coming down over the last couple of months. The ES6 has never really been a strong seller and has been flatlining for a long time, and has like a long-term reducing trend, and then also the NIO ET7 never had seen really significant sales success, and the other models, the ES7 and the EC7, they are really not needle mover because they simply sell at too low volume with annual sales of below 5,000 vehicles. So when all these vehicles have such poor trends, what is driving NIO's vehicle volume? It's simple. It's all based on a product portfolio expansion, and this is the costliest way how you can drive volumes, essentially, except for discounts. And this is what you see here. So the clear volume driver was here it's labeled as Lerdao. This is the Chinese name of the Onvo brand. So just keep this in mind whenever you see in this presentation Lerdao, it means Onvo. And so that's the Onvo L60 vehicle, which is a direct competitor to the Tesla Model Y in China. However, it's priced significantly below the Tesla Model Y. This was clearly the volume driver. And this, in recent months, there was another vehicle launch, which was the Firefly. I'm sorry, there's a small typo here in this label, but it doesn't matter. The Firefly also kicked off. We don't have a full trailing 12 months period. I expect this to contribute more meaningfully in coming months, because it's an even lower price point vehicle than the Onvo L60. So this will continue to drive volume. And then down here, barely visible, there's the latest NIO product, which is the ET9. It's a more, it's basically the new high end of NIO, but this will not sell significant volumes. So the key takeaway from this slide is that the NIO brand suffers from stagnation or shrinkage, and the volume growth was entirely driven by significantly lower price point vehicles. I'm jumping now to slide 5 because that makes more sense to discuss now. This slide shows you the volume by brand as reported, and then going forward as forecast in the model. And the average selling price of each brand, and the average selling price was derived by volume weighted disclosed price ranges per model. So this gives you a fairly accurate estimate. And when you look down here in black, you see the total volume weighted price point of the company, and you can see how significantly that number came down. For example, at the end of 2023, the average price point of a NIO product was $42,300 and has reduced by Q1 this year to only $32,400. And you can see that the primary drivers up here, it's the Onvo brand, which is this orange logo up here. And later you see the effects of Firefly. And the reason is very simple. Down here you see the average selling prices of the Onvo brand. And when you have an average price point from a NIO brand, here for example in 3Q 2024, when Onvo launched, of 37,300, and Onvo launches at 16,300. Obviously, as Onvo ramps, contributes more and more vehicle volume, it causes significant dilution in average selling price. And this is exactly what you see in this price trend. So now, despite this diluting price point, the forecast, the cost assumptions embedded in the forecast imply a significant improvement in gross margin. For example, the total gross margin for NIO across both the vehicle segment and the other segment was 7.6 in the first quarter of 2025, and by the end of the explicit forecast, which is 4Q 2026, the forecast implies an increase to 16.6% gross margin. The auto business is part of this total gross margin is even significantly higher. The forecast assumes that the auto business goes from 10.2% gross margin achieved in Q1 2025 to 18.3% in end of 2026. As you will see in a second, 18.3% is a fairly aggressive gross margin assumption in the current global automotive environment. This chart is proving this point. This is not showing pure auto gross margin. This is showing total company gross margin as reported. So the number that we have to use to compare it with is the 16.6% gross margin, the model forecast by the end of the forecast period. So this is this dashed line here, and you can see that 16.6% would exceed Tesla's, which is or was 16.3% in Q1. It would also exceed XPeng's all-time highest gross margin of 15.6% delivered in the first quarter would obviously significantly beat Nissan at 12.1%, SAIC and 10.2%, and would mean a major increase from NIO's current gross margin of just 7.6%. So here the bottom line is the gross margin projection, or the implied gross margin from the model, is very bullish. This chart shows you the resulting gross profitability. NIO generated in 2024 for the full year 0.9 billion in gross profit. The forecast implies gross profit increases to 1.4 billion in 2025 and grows further to 2.4 billion in 2026. This chart shows you the projected operating cost base, OPEX, and you can see how this forecast assumes that NIO's cost base actually shrinks a little bit in 2025 to 3.8 billion from 3.9 billion in 2024, despite the brand expansions, Firefly Onboard, plus various vehicle launches, plus certain other things, and increasing scale. So it is a very aggressive forecast. And that in 2026, operating expenses basically stay constant, only grow 1.5% year on year. So again, this cost base, these cost base assumptions are highly aggressive or very bullish, and also the gross margin assumption is very aggressive. This then shows you the resulting efficiency ratios, and because revenue is growing so much from all the additional volume, and we keep the operating expense base basically flat, you see how R&D and SG&A efficiency ratios significantly improve. So just a reminder, efficiency ratios are simply R&D expense divided by total revenues and SG&A divided by total revenues. So for example, in 2024, NIO spent almost 44% of revenue just on R&D and SG&A. Forecast assumes this goes down to just under 37% in 2025, and then it reduces significantly in 2026 to just 26% of revenue. Compared to XPeng, NIO has a substantially higher cost base. This has a number of reasons that basically add up. I just give you a few examples. One is obviously NIO's battery swapping business, which is highly loss-making. Then NIO's premature global expansion into, for example, the European market, which is highly loss-making. NIO's focus on early on establishing a premium brand. NIO in many big cities always has like the most premium showrooms. For example, in Shanghai, NIO's showroom has like the prime real estate in the tallest tower in Shanghai. The same is true for similar high-end locations in various other big cities. So they're really overspending on a lot of things. And showrooms is one thing, but when you look at the numbers and look at showrooms and add the two together, it's really indicative of maybe the corporate culture, which is like, let's create great customer experience and not worry about the money too much. And I think this is probably going on at NIO. There's probably a poor culture of cost control, basically very similar to what we can see in Rivian. Then when we add everything together, what's the outcome of all of that? The outcome is that NIO's operating profit will only modestly decrease in 2025 from 3 billion in 2024 to 2025, 2.4 billion. And then there's a material further decrease in losses in 2026 to 1.4 billion in operating losses. But you can see that even though this forecast is very bullish on gross margin plus operating expense base, it still results in quite material operating losses. This chart shows you the implied operating margin. You can see NIO does not get out of negativity. And this chart shows you NIO's current 53% negative operating margin. Shows you a bunch of global automotive peers. There are a bunch of key observations, and then also it shows you the end state of the forecast to Q4 2026 and the negative 3.2% operating margin, where this would put NIO in the global automotive landscape. It would beat XPeng, which has much better cost control and has much less baggage, is also currently materially larger in terms of volume and other metrics than NIO. But NIO will be at this end state in 2026, if the forecast is correct, significantly larger than XPeng, so that's something to keep in mind. But XPeng has a bunch of other things going for it. It's also playing in the robotic space. But what you can take away here is that even once you get out of operating losses, as a pure auto business, the margins are never going to be great. And you can see this up here, that the best performing companies right now, for example, Kia, 10.7% operating margin, is part of a huge Hyundai group and has numerous advantages going for it. NIO has none of that. So even the end state for NIO is likely very unattractive, but at least over the forecast horizon, NIO appears to be still very unattractive. So the next one is more or less a housekeeping item. This just shows you, for completeness, non-operating items. This is not a needle-moving item, so not worth spending time on this. Then we get to profit before tax. Is basically almost identical to operating profit, because non-operating items are not needle-moving. Picture is the same as before when we looked at operating profits, losses in 2025 at 2.4 billion, and then go down to 1.4 billion in 2026. This chart shows you then the implied operating margin profile, which is very similar to the operating margin. So this is profit margin, so it divides pre-tax profit divided by total revenue, and you can see even the end state after all these bullish assumptions is still a negative margin of 3% at the end of 2026. Here's just a quick look at taxation, also very conservative assumptions. There's basically no taxation for NIO. Then we get to shareholders' net income. Also because of lack of non-operating items, lack of tax, shareholders' net income, and because of a very small amount of non-controlling interest, shareholders' net income is essentially the same as operating profit in NIO's case, and here the same. So this year in 2025, I think for the full year, NIO will generate 2.4 billion in shareholder losses, and then there will be another 1.4 billion in 2026. So for people who know the market might wonder, okay, why is XPeng nearly double the valuation of NIO? So number one, XPeng is a little larger, but there are also some qualitative advantages that XPeng has. So first of all, the XPeng, despite larger size, has a smaller operating expense base. Number two, XPeng makes more competitive product. And to show you what I mean by that, let's take a look at EV revenue generation in China. So we take a look at this database. Here is XPeng. Here you see all the products, and this is on a monthly basis. And so the latest numbers for June, XPeng generated in China $800 million in pure EV sales revenue, and you can see it had these four products. There was one product was generating 165 million, 94 million, 90 million, 2 million, so smaller product. It was the P7, and then so this product is already dead, which was the P5, and then the most revenue generating product was the Mona M03, which is a lower cost vehicle, which is comparable to the Tesla Model 3, a sedan, but at much lower cost. And then there's the new P7 Plus. You can see this vehicle started sales only in October, ramped to 184 million now monthly sales. And then there's the recently launched G7. So basically, they had these 7 products in the market. So if you now, so just keep these numbers roughly in mind. So top seller 260 million, and then there was another one with 160 million. And 184 million, and then there was like two just under 100 million. So if we look at NIO, 1 second. Sorry, here's NIO. So NIO had a lot more product in the market, and you can see there is no product with. So first of all, it has a lot more products. You see here how many is this? Is 3, 4, 5, 6, 7, 8, 9, 10, 11. So NIO right now sells 11 products in China. There is no product that generates more than 200 million. The top selling product in June was only making 173 million. There was another, which is the ET5T. And then there's the ES6. But then it quickly drops off, and then you have the new Onvo L60 has become the third highest revenue generator. But keep in mind, is a much lower price point vehicle and has likely a much lower margin. And the other products are really not doing that well, as you can see by most of them being significantly below 100 million in monthly revenue. And this is China, and NIO is not really selling any meaningful volume outside of China. So this is effectively a very good proxy for the whole of the company. Something I will discuss in a separate video will be NIO's capital situation, which is a little bit complicated in NIO's case because NIO does not provide a quarterly cash flow statement. That's why any cash flow analysis outside of full year disclosure has to be done on P&L numbers and of course balance sheet numbers. But this will be a topic for another video. But the result is already obvious. NIO is running out of cash, and they will try to liquidate certain assets I covered before, and they will also obviously try to raise more debt and equity instruments, or I should say they issue debt and equity instruments. Before I let you go, I just show you real quick something interesting about NIO, because so these are key balance sheet numbers as of March 2025, and what you see is that the amount of interest-bearing liabilities came down in the first quarter. However, the continuing losses decreased equity to negative, which then results in a leverage ratio that is extremely high. It's basically a crazy number. So leverage ratio in this case is defined as debt divided by capital, and capital is the sum of equity and debt. This significantly lowers the amount of debt NIO can raise. However, NIO has other venues to raise a type of debt. And this is what you see in this analysis. This shows you DPOs. So DPOs is days payables outstanding, and it's an approximation of how long it takes an automaker to pay on average their suppliers. And you can see in NIO's case, it's extremely high. It's 266 days, while established automakers in Europe, North America typically pay anywhere between, call it 40 to 60, 70 days. The Chinese all, because of the fierce competition, try to get as much supplier financing as they can, and that's why you see these extremely elevated numbers. Xpeng is also very high. But one thing to point out, Q1, because sales in China always drop in Q1, it temporarily inflates the DPO metric. So I expect these numbers to come down significantly, but still, even if you look at the period before Q1, you can see that in NIO's case it was at 171, which is extremely high. And also when you look at BYD before the typical Q1 spike was also in Q4 at over 100 days, which is also extremely high. So long story short, NIO is significantly running out of funding runway. They have limited ability to further tap into supplier funding. The negative equity limits how much debt they can raise. So they're basically limited to dilutive equity issuances. This increases the share count, which makes NIO even more expensive given the current outlook. It will drive up any future multiple NIO might receive once it gets profitable, and then also will force probably soon certain sell downs. By sell downs, I can give you a couple of examples, but to cut this video short, I just give you one. NIO could, for example, spin off its chip design department. So to wrap up, we go back to the share price chart. I believe at the current valuation, given the abysmal financial outlook, even if you assume quite aggressive, even if you make very aggressive assumptions, it looks pretty bad. So I would recommend, it's not trading advice at all. You need to come to your own conclusions, but NIO, if it runs up further, is probably a good candidate to build slowly, average up a short position, because it's unlikely that the stock can sustain a share price level near or above $5 per share. With that, I hope this was helpful. See you next one. Thank you. Bye bye.